Good day. My name is David Brooks, your licensed financial professional. Today I'm going to be talking about doesn't universal life insurance cost more the older you are? Well, here's an example of a client earning 11%, but they're netting 10%. So the cost of insurance is only 1%. And so basically, when you get 10% cash on cash is a rate of return. It's only 1%, one of those percentage points pays for the insurance that the IRS says has to be there in order for the interest inside of insurance policy to be tax-free. And that's called the internal rate of return. And so the IRS in the 80s took E.F. Hutton to court saying, why would someone put $500,000 at one time into a life insurance policy with a death benefit of, say, $520,000? But that's called self-insuring, self-insurance, or just self-insuring yourself. The client was not violating Section 72E, 7702, or 101A of the Internal Revenue Code. So the long story is the IRS went to Congress and said we need to make some changes. So in 1982, they came up with the Tax Equity Fiscal Responsibility Act, better known as TEFRA. And the IRS didn't really know what they were doing. So then 2 years later, they had to make some changes, and they redefined it again under the Deficit Reduction Act, known as DEFRA. So of 1984. This is called the TEFRA-DEFRA corridor. So under the TEFRA-DEFRA Act, the IRS basically dictated the minimum amount of life insurance benefit someone would need and the death benefit that must come along for the ride under a maximum funded insurance contract in order for you to not violate the definition of tax-free accumulation, tax-free access, and tax-free transfer of the death benefit to your family. And that's all under Section 72E, 7702, and 101 of the Internal Revenue Code. And so the IRS knows your objective is to have tax-free living benefits. And so they gave it parity and equality. So if someone wants to put in $500,000, let's say a 6-year-old wants to put $500,000 into a life insurance policy, well, the 6-year-old must have $1.2 million worth of life insurance. And say if a 21-year-old wanted to get $1.2 million worth of life insurance, but they couldn't put in $500,000 because the older you are, the more money you can put inside the policy, and the younger you are, the less money you can put inside a life insurance policy. And so that's how they made the parity. And so as your money grows, the insurance becomes cheaper as you get older. And the insurance policy must stay 5% ahead of the cash value, so the cost of insurance is going down as you get older. But what if you're totally uninsurable? Well, you can own a policy on someone else, like a surrogate, your spouse, your kids. Banks own life insurance on executives, and it's called BOLI, which stands for Bank-Owned Life Insurance. The owner of the insurance contract gets all the tax-free accumulation and growth. So if you can't qualify for life insurance, you can get the tax-free growth by insuring someone else, someone else's life to be insured. You can also keep insurance on the oldest family member when they pass away, it blossoms, and then you can take 20% of the death benefit, tax-free, get life insurance on the next oldest, healthiest person in your family, and now your family is empowered and endowed with tax-free capital for generations to come. So if you'd like to learn more about this, just click on my link below, just like and follow, and you can also book an appointment on my calendar. So my name is David Brooks, your licensed financial professional, and that's my tip for the day. And you guys have a great day.